pull up the intraday graph. From almost 24,400 odd, we went lower, cracked and recovered very sharply. What an interesting market. All the cracks are becoming shallower and falls are cushioned. Shibani Sircar is here. Shibani, on the one hand, if we look at what is making market nervous, there is talk of STT being hiked in the budget in order to curb FNO. I mean, two strategists have actually put it in writing, Jeffries and Morgan Stanley this morning. Then there is talk of recommendation papers on how to curb FNO. There's the NSE margin list which has come out. So much stuff is being done to keep the market not developing froths. But the liquidity, the very good liquidity positions from SIP, from EPF, from insurance money, it's cushioning the falls. Very interesting market we are in. How are you looking at it?
Hi, good afternoon. So yes, absolutely. It's a very, very interesting market at this point in time. On one hand, as you correctly pointed out, the liquidity from flows into mutual funds such as ours remains fairly strong, and the SIP data corroborates that, as well as the net equity flow data that you saw come out for the month as well. On the other hand, of course, we will have to wait and see what are the changes that are proposed from a regulatory perspective across various parameters. However, when you look at the very fact that if you look at the overall financial savings pie in India and the proportion of equity in that pie, on a relative basis, India still remains fairly small. And therefore, the room for expansion in terms of investments into equities as a medium for long-term wealth creation remains fairly intact. Secondly, from a market perspective, of course, we've seen a fairly great run in the market. Even post-elections, we've seen the market move up once the government formation was done. And therefore, with this sort of market move and with valuations where they are, it is but normal to expect some degree of near-term volatility. But when you just take a step back and think about the market, the very factors that have been driving the market are intact, whether it be in terms of macroeconomic parameters, corporate earnings, and we are now stepping into the Q1 of FY25 earnings season, and flows as we were discussing. So in this context, when we look at market, we have to look at valuations. And in that context, as we have been saying clearly, that the risk reward at this point in time seems to be favoring the large caps and some of the larger mid caps, vis-a-vis small caps and micro caps, where valuations have been stretched on a relative basis, as well as in comparison to their own history. Now, if you look at from a market perspective, we do believe that the earnings trajectory for FY25 and 26 are still fairly intact. And mid-teens earnings growth in the context of almost 24% earnings growth for Nifty last year, which is FY24, is a very, very good outcome. And therefore, earnings will clearly be the driver for markets. And in the near term, we will have the budget to watch out for in terms of the policy direction that the government is taking.
Shibani, there is talk that this budget, the government may actually take up the shipping space, address it and boost investment in shipping, opening up of setting up yards, ship repair, shipbuilding. This space has not seen very specific focus from the government so far, development of ports, etc. What are your thoughts here? Many half a dozen stocks could get impacted, but what do you see? What do you think of it?
Yeah, so I think, while it's difficult to say specifically which segment on the infrastructure side that the government will focus, I think the overall tone in terms of policy will remain in terms of investment-led growth. In the past, we've seen focus on roads, railways, and maybe the focus shifts towards ports and shipyards in terms of freeing up bottlenecks and therefore leading to overall growth and making India a manufacturing hub of sorts. I think the government and the overall budget, the way the finances look, there is adequate opportunity and adequate fiscal room for the government to continue to spend on infrastructure and investment-led growth. Remember the fact that RBI dividend of almost 2.1 lakh crores, which has come in, also gives them the room to not only look at investment-led growth, but also look at possibly taking measures to boost demand at the bottom of the pyramid and mass consumption, which is also something that is going to be important to watch out from a budget perspective. So two things. One, the overall infra space and the investment-led growth will possibly continue. We'll have to wait and see what are the allocations that are made to specific industries and segments, which we will get to know shortly. But and the second factor, of course, will be what happens in terms of rural as well as allocations to boost demand at the bottom of the pyramid.
which area of the market, in your view, Shibani, is most attractive right now on risk reward basis?
Yeah. So I think from our perspective, if you look at risk reward, there are two sectors that we are focusing on, where valuations, we believe, relative to their own history, these sectors are trading at fairly reasonable multiples. The first segment is the private sector banking pack for some of the larger banks, where we believe that, if you look at the improvement that has happened both in terms of balance sheet as well as return ratios over the past few years, is not reflected in terms of valuations. There have been concerns in terms of margin compression, but we believe that we are possibly coming close to a cycle of margin compression, and margins over the next few quarters should start to bottom out and remain stable. The interest rate cut cycle seems to have been pushed out a bit, which again aids margins, and valuations clearly are fairly comfortable. The second factor and the sector that we are looking out for, and possibly where again we have valuation comfort, is the entire consumption space, specifically staples. If you look at some of the commentary that is coming through from some of the staples companies, incrementally it does appear that rural demand is picking up, though at a very steady pace. It's not a sharp pickup and recovery. If you look at in terms of the inflation-led input cost pressures that were bringing down real rural wages, that has started to abate at the margin. And various data points, whether it be two-wheeler sales, whether it be Manrega employment data, seems to suggest that possibly the worst is over from the rural perspective. So consumers is another segment that we are watching out for. Structurally, however, if you look at our positioning, we continue to remain fairly positive on the entire capital goods manufacturing and auto space. However, we are also cognizant of the fact that in pockets, there are valuations which have moved up considerably. And therefore, incrementally, one would have to look at segments and the names within these sectors where valuations are favorable on a relative basis.
Parts of the market, do you feel, there is clearly a lot of froth actually, and trimming position is the right way?
So yes, so the way we are looking at the market risk reward, as we were discussing earlier, seems to be more favorable for large caps over mid and small caps. So that's something that we are cognizant of. In the medium term, if earnings continues to play out the way the market is believing it to be and what the consensus numbers are showing with mid-teens earnings growth for 25 and 26, that earnings trajectory is a fairly strong earnings trajectory in a background of stable macroeconomic parameters. So from that perspective, in the medium term, we continue to remain positive on the markets. From a sectoral perspective, of course, we have to look at some sectors where valuations offer comfort, which is the two sectors that we discussed. Apart from that, we would also keep a close watch on the large cap tech space, where again valuations are fairly comfortable, and the chemical segment, which has again seen a significant drawdown in the last few years because of various global issues, which has brought down profitability in the sector. But yes, so one has to be specific in the market in terms of stock picking, look at growth opportunities, but keep an eye on valuations.
Would you be a buyer in some of these market infrastructure names if the stocks actually fall further? I'm talking about certain wealth management companies, some big technology backed brokerages in the listed space. They have fallen quite a lot, almost 40-50% from top, some of the names already on curbs on F&O, etc. If budget doesn't throw up and these companies also kind of diversify away from broking alone, is there merit to get into some of these name and weaknesses?
Yes, absolutely. So we are keeping a close watch in terms of what the budget brings to the table in terms of proposed changes. But as we were discussing, if you look at the entire trend of financialization of savings and equity markets being a dominant part incrementally in the entire pool of financialization, we believe that there is still a long runway for growth. Of course, we'll have to look at it from a stock specific perspective, but various parts of the entire space offer opportunity to play that trend of improvement in terms of savings through the equity pie. The business models, as you rightly pointed out, are evolving in different ways, and therefore that is something that we will watch out for. Of course, valuations in this segment have become rich, and therefore we will possibly look at better entry points into the entire space. But structurally, we believe that the opportunity set remains fairly intact.
Just last word, Shibani, do you think there is froth in small caps? Or it's not right to look at it in the same, all small caps should not be weighed together?
Absolutely. So I think, when you look at just small cap valuations, one would say that yes, there is froth. The small cap index per se is trading at multiples which are almost at a premium of almost 40% premium to their long-term averages. However, we have to look at various segments of the small cap space in context of growth. So while multiples have moved up sharply, remember this entire segment has also seen significant improvement in terms of earnings growth, and therefore some of the multiple expansion is possibly reflective of that. However, within the space, if there are a set of companies which have moved up, one, because of low float, and secondly, where fundamentals don't justify current valuations, those are segments where we would be cautious on. This debate on small and mid caps is possibly likely to continue given the kind of multiples that the segment trades at. But within the segment, one has to be, of course, stock specific in nature. There would be pockets of opportunity, but pockets where froth is clearly visible, and therefore one has to be discerning in terms of the kind of stocks that one picks in the space.
All right, Shibani, we'll let you go on that one. Thanks so much for joining us on the show today. Take a break. Meanwhile, also hear out Surinder Goyal from Citi on the sectors he like.
If you like this video, then like, share and subscribe to ET Now.